Everybody, it is Thursday, the 22nd of March, 2018, and the market sold off pretty strong here today. It did undercut the low from earlier in the month, and we came right down to the 61.8% retracement of that panic low in February to the March high. So where do we go from here? Well, we're a little bit oversold, of course. That means we've just come down pretty far pretty quickly. If you ask yourself, where has it come from 280 down to 263, 264 in just a couple of weeks here, it means that it's most likely that we get a bounce in here, but there is zero evidence that any such bounce is materializing. So we're not going to be stupid and just throw our money into the abyss and try to look for a low and play guessing games. Instead, we're going to look at bigger levels and say, where else are we? Well, we're also at a 150-day moving average, and below that, the next level of interest would be the 200-day moving average, which is just under $260. And let me just clear that up, and you can see that I had some VWAPs drawn in there from this peak, from this low. That kind of, from this low right here kind of comes together with that 200-day moving average. So it seems most likely that maybe because we never know for sure, that we do get some sort of bounce. And I think even from here, and maybe it does, maybe it does this, and then we get our next bigger leg lower. All I know is we've expended some good energy getting down to where we are, and we are below key levels here as far as the VWAPs go. We are below the volume weighted average price from the low. We saw that on the Federal Reserve meeting, we ran right up to that volume weighted average price year to date, and that's where we were expecting to see sellers, as that also tied together with the 50-day, the declining 5-day moving average and the volume weighted average price from that March low. So those levels came together in the right place, and then the market is now doing what it's supposed to do in a market where we do have, at this point, a declining 50-day moving average. The market's been open for 55 days, counting today, and we're getting rid of data from back over here right now. So that means that the market is going to have to start to really ascend if we're going to see this 50-day moving average advance. I don't think that's likely. This is the data we're going to be getting rid of in the actually right from about here. This is the data that we're going to be getting rid of in that 50-day moving average calculation. That means even if the market rallies up to 274-ish, where that 50-day moving average is, the 50-day moving average will continue to decline. So it's most likely that rallies from here on out will fail until we have more time to test that 200-day moving average and build a deeper level of support. So the nature of the market has clearly changed. The NASDAQ, as we spoke about over here, from failed moves come fast moves. That's exactly what we have. This market, it still has a rising 50-day moving average, but let's consider what we're getting rid of. If we take out the first 5 days of the year right here, tomorrow we start calculating out this data. So for the next 2 weeks, we're going to have to see the market above where this average is today in order to not see the 50-day moving average begin to decline. That means the 50-day moving average basically is going to start declining here for the next 2 weeks at least, until we start to get rid of this data. So we're seeing a lot of volatility, and it seems most likely to me that we will come down and test some of the bigger levels. Maybe, first up, we haven't undercut the March lows yet. Here's a 100-day moving average, which has been important to the NASDAQ. So, if we undercut this low, which seems pretty much guaranteed, then keep an eye on the 100-day moving average, and then we will look at the 150 and the 200-day moving average. But the fact is, the tone of the market has changed. That is a fact. It's not an opinion. The NASDAQ, the Russell 2000, we have zero evidence that this is a double top right here. Only a double top once we've undercut this low. So we're not going to be interested in that kind of analysis. Instead, we're going to look, as we always do, to the shorter term time frames. We talked about the relative performance of the Russell 2000, but we're very careful to say, here's the scenario we want to see, and it needs to break above this band of resistance and see that 5-day moving average advance if we're going to trust this market. Instead, the market gapped lower, it's back below the declining 5-day moving average, and this is why you don't make those cheat buys trying to be cute and get ahead of the game, especially when the broader market is showing more weakness. So today, that outperformance that people were talking about early on, and myself included, the last couple days, completely disintegrated. And here we can find ourselves on that 130-minute time frame. We are below the year-to-date volume-weighted average price. That's this one right here, and we are coming down to the volume-weighted average price from the February low. So it seems like it might be able to bounce in here. Let's take a look at the first 5 days of this year and figure out what's going to happen to that 50-day moving average. Well, as this market replaces this data, that 50-day moving average, which is kind of flat right now, is going to start to take a declining note to it. So something that might happen in these markets is that we see something like this over the next week, week and a half before we continue down. So we can do that in the SPY as well. Well, the SPY, it's still up there, but maybe the Nasdaq rallies up to it in the next week or so, and then we see the bigger sell-off. It's difficult to make money on the short side when you sell short after the market has made a big drop into a significant level. This level at 162, if we undercut that slightly, we might start to see a bounce. But again, it's not to be trusted with a declining 5-day moving average. I don't know how many times I say that, but I say it constantly, and I hope it saves you and helps you make a lot of money. Same is true with the semiconductors. The semiconductors did catch up on the downside here late in the day, but still, it's relatively a better performer. Would you rather lose 2% or 10%? That's my opinion of relative strength. It doesn't matter if it's relatively strong if you're losing money. Here we are now in danger of this breakout being a failed one, and from that we might start to see the semiconductors catch up on the downside. The first most important level would be about that 104 level, and more than likely it would undercut this level slightly before it was to get a bounce. So again, we have to be careful. The market has been telling us to be careful and cautious, and I've been closing out these videos each of the last few days saying this isn't the market we want, it's the market we have, so we have to deal with what we have. The biotechs, failure here too. That 50-day moving average is now declining, and that makes sense because we're averaging out these 5 days, and for the next 2 weeks we're going to be averaging out these days. So a test of the 200-day moving average seems imminent. We broke below the volume weighted average price from the February lows, and this market is looking like it still has further downside. We can draw a trend line that looks like this, and maybe we'll get a little bounce from that tomorrow. Why don't we draw the trend line off of this? Well, one, because it's broken, and two, because this represents more the essence of trend in my opinion. So we're not looking at it as a buy point anyways. Trend lines, moving averages, volume weighted average price levels are levels of interest, not areas to purchase, but areas to look at the market on a shorter term time frame and say, is there evidence that the buyers are regaining control? And so far, for all of these levels in these markets, the answer is no. There is zero evidence that the buyers are trying to gain control.